Thank you for joining me. I'm Alex, and I want to talk about Atlassian today. Atlassian is a name that most people don't know, even though they produce the bane of the existence of many programmers all over the world, which is Jira. They also have Confluence and Bitbucket and SourceTree. As I said, many of the bane of existence of many programmers. So surprisingly, price is $187.52, which gives them a market cap of $46.7 billion, which is quite a bit. Dividend is zero. I wouldn't expect that to change, especially with the current earnings. Revenue $1.6 billion, up about 33%. Earnings negative $351 million, which is down, I guess, from negative $638 million. So you would think that a company producing tools that are used in many of the world's biggest companies would be having revenue like higher than $1.6 billion, but I guess you would be wrong. Earnings also kind of terrible. So that gives them a PE of negative 100, forward PE 143. So you kind of want to stay under 20. So 143 is just a tad high for my taste. Total assets $3.9 billion, total liabilities $3.3 billion, which gives them a total stockholders' equity of $575 million, which actually went up when they lost $350 million, which is kind of confusing to me, but I guess I'll take it. So risk factors, I don't really think there's a lot of risk factors, but obviously, if you're a big software company, you can make comparable tools to Jira that probably perform better in your extremely specific environment. But I feel like with all the integrations they have, Jira is definitely a decent product. Apparently, they just need to start charging more money for it because revenue of $1.6 billion is really ridiculous considering what they do. So I don't think that there's actually a lot of risk factors outside of people just choosing not to use their software. I really don't think that there will be a big competitor anytime soon, considering how complicated their products are and how scalable is, I guess, what I want to say to that. So overall, obviously for a dividend investor, there's absolutely nothing here. For a growth investor, there is actually decent growth, and this is actually a growth stock, obviously. I do think that considering the PE and the forward PE of 143, that even for a growth company that we're kind of living dangerously investing in a company that loses $350 million a year, which is far better than they did before. But still, if they actually can get to a forward PE of 143, then they would turn that into a profit of like what, $250 million, and that would be pretty decent. But for a company with a market cap of $46 billion, I don't think that's really high enough. So overall, I think that if you're a growth investor and if you believe in this company, I don't think this is an absolutely terrible buy, but the horizon needs to be far out. So you're looking at maybe 5-ish years to get to a decent PE, and that's if things continue the way they are. For a value investor, obviously the earnings are terrible, PE is terrible, the balance sheet is fairly terrible. I mean, I've seen worse, but it's definitely not a great balance sheet. So overall, you would kind of be speculating on growth and maybe getting to a decent PE at some point, and I really don't think value investors should be doing that. So overall, if you're a growth investor, I guess you can try to have a look at this and try to find something that really is a good thing. But for me, I'm going to definitely pass on this. That's it for me for today. If you like this video, make sure to subscribe. I'm coming out with more videos every day before market open. I hope you have a successful day.